Today, we're taking a deep dive into Zhongfeng Electronics, a critical player in the semiconductor supply chain. This is a company that finds itself at a significant inflection point, with a market valuation that is, frankly, priced for perfection. Our analysis will dissect the high-stakes bet the market is making here, balancing the explosive growth story against a series of considerable risks. So let's lay out the core equation right from the start. What we have is a company trading at a historically high valuation. This is being driven by a very ambitious growth strategy. At the same time, though, it's shadowed by notable governance concerns and significant execution risks. The market price doesn't just reflect optimism. It reflects a conviction that the company's plan will be executed flawlessly. And that's the central tension we need to unpack. To do that, we've structured our analysis into 4 parts. First, we'll examine the bull case, the dual-engine growth story that's fueling all this optimism. Then, we will pivot to the other side of the ledger and identify the key governance and execution risks. After that, we'll synthesize these 2 opposing views to really understand the anatomy of its current valuation. And finally, we'll take a quick look at the core technology that underpins the entire operation. All right, let's begin with the bull case. To truly understand the market's enthusiasm, we have to look closely at the company's very compelling dual-engine growth narrative. It's built on 2 business lines that are distinct, but also highly synergistic. The company's original foundational business is in what are called sputtering targets. Now, the easiest way to conceptualize this is to think of it as ultra-pure metal ink. This material is absolutely fundamental for creating the billions of microscopic electrical pathways inside every advanced computer chip. This is the bedrock of their business. But the real driver of the current market excitement is the company's newer strategic focus, precision parts. So to stick with our analogy, if the sputtering targets are the ink, then these precision parts are the high-precision tools. They are the critical, consumable components inside the multi-million-dollar manufacturing equipment that ensure the ink is applied with absolute perfection time and time again. And this chart really illustrates that strategic shift in quantitative terms. The data here is pretty clear. While the core sputtering target business continues to show steady growth, the precision parts segment is expanding at a dramatically faster rate. This differential is exactly what the market has latched onto as the company's powerful second growth curve. And to put a finer point on it, 55.53%. That was the year-over-year revenue growth for precision parts in 2023. That level of expansion in a high-tech manufacturing sector is truly significant. It's the number that really validates the company's strategic pivot and fuels this whole narrative of it becoming a future platform company. And it's crucial to understand this growth isn't happening in a vacuum. It's supported by several fundamental drivers. First, you have powerful macro tailwinds, things like AI and the push for national semiconductor self-sufficiency. Second, they have a blue-chip customer base, which provides a pretty significant competitive moat. Third, a substantial recent capital injection is in place to fund this expansion. And finally, there's a powerful flywheel effect, where they can leverage the trust from their core business to cross-sell these new parts. Okay, now let's turn to the other side of the coin, because this very optimistic outlook is tempered by some pretty significant challenges, specifically around corporate governance and, well, the immense difficulty of execution. The first key data point in the bear case is this one, 36.41%. This represents the portion of the founder's stock that was pledged as collateral for loans, as of the latest reporting period. Now, for any analyst, a figure this high is a major metric, as it can signal potential financial fragility right at the highest level of corporate control. And why does this matter so much? Well, because high pledges create a risk of forced selling. If the stock price were to fall for any reason, it could trigger margin calls. That could lead to a cascade of selling pressure that has absolutely nothing to do with the company's actual business performance. It's a significant overhang. Compounding this financial risk is a period of pretty significant leadership turnover. As this timeline shows, key C-suite roles, we're talking general manager, chairman, and board secretary, have all changed hands in a relatively short period. This level of instability raises serious questions about strategic continuity, and it's happening at the exact moment the company is attempting its most critical expansion. And this brings us to the core execution risk. What you have is a recently structured management team that must now deliver on an incredibly complex and capital-intensive plan. The market's valuation implies that the margin for error here is exceptionally thin. So the question becomes, how do we reconcile these two powerful opposing narratives? By bringing them together, we can really begin to dissect the anatomy of the company's current, historically high valuation. It really is two sides of the same coin. On one side, you've got this compelling story of dual-engine growth, and it's backed by strong fundamentals. But on the other, you have very tangible risks in execution, governance, and financial structure. The current market price represents the equilibrium point between these two powerful forces. Placing this in a historical context is quite revealing. As the table shows, the company's price-to-earnings ratio is currently trading in a range of 50 to 70 times. This is at the absolute upper end of its historical band, and it reflects a market sentiment that can really only be described as extremely optimistic. So here's the crucial takeaway. The market valuation isn't just reflecting the company's performance today, it appears to have fully priced in the successful outcome of its future strategy. It assumes that the second growth curve will be executed perfectly, with all of the risks we've discussed being seamlessly navigated. And finally, to fully grasp the stakes involved in this high-risk execution plan, let's just briefly revisit the core technology itself and what it is the company actually produces. In essence, building a chip is a bit like building a microscopic city. The sputtering targets provide the ink to draw the roadways. The precision parts are the tools that ensure those roadways are drawn perfectly. Qianfeng's entire strategy is to supply both the essential materials and the critical tools to the world's most advanced builders. And so, this leaves us with the central question. With a new leadership team, a complex strategic pivot, and a market valuation that demands perfection, the defining issue really comes down to one thing: execution. Can this company deliver the truly flawless performance that its stock price is already priced in? That remains the critical question.